All right, let me talk about it just a little bit here. Fundamental focus is where we have Coach Greg, the old Money Holmes, moniker that he has. He teaches some concept in the fundamental analysis part of the market. Whether it's PE ratios, valuation, debt to equity. We've done many of them in the last several weeks. Today, Greg is going to be talking about PEG ratios, from what I understand. Greg, take it over, man. Run with it.
All right. Yeah. So this is, talking to Matt, the pre-production there. Going into the PEG ratio is kind of a natural flow. We've talked about price to earnings. We've talked about price to sales. We've talked to, about debt to equity last week. We've went into a bunch of different metrics. And the reality is with fundamentals, we're trying to build a picture here. That's what we're trying to do, build a picture of a company. These are all valuation metrics. Well, the one that we haven't talked about yet is a very important one, and it takes into consideration the growth component. That's a PEG ratio. So basically it's price, earnings, growth. Okay. So why does that matter? Well, there's always, you always got to kind of define it before you can really understand it. So defining it, why does growth matter? Take a company that is maybe somewhat new, right? Reasonably new, and maybe they haven't started earning, capital yet. Maybe they haven't broke that barrier, but yet they have this growth potential. We expect good things out of them going into the future. That's where a PEG ratio can tell us a lot more than a price to earnings. So a price to earnings, just to go back and reiterate that. Basically, it's the price you pay for the stock for $1 of earnings. Okay, so I've always heard it this way: it's what you pay and what you get. Right? It's a value metric. Well, now what we want to do is we want to say, okay, well, let's say there's a company out there that has earnings of zero or negative, right? And you're still being asked to pay a certain price for the stock. Well, that metric becomes virtually, I want to say, almost useless at that point, because it doesn't really give you a clear picture of the overall company. This is where a PEG ratio comes in. Now we're saying, okay, yeah, we don't have any earnings yet, but maybe if we look at the business model, maybe we have expectations of earnings down the road. Okay, and there's only one company that I can give you that I think is fantastic in this respect, and that's Tesla. Okay, so Matt pointed out today, 186, 145, 193, et cetera, et cetera. Well, if we go back far enough, and I'm just going to do this very quickly for you guys, let's go back 10 years here. Okay, we're going to look at a few earnings here. Negative, 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 right? All these negative numbers, if we just looked at a price to earnings ratio, that doesn't really give us a good picture of the stock. Okay, and so there's a more telling chart that I have here that I think is even more important. So this is called macrotrends.net. It's just a free website, but I want to show you guys this chart here. Okay, so this tells you the stock price. This is basically that chart we just looked on Thinkorswim. But the most important thing here is it also shows you your trailing 12 months net earnings per share. Okay, so you can see that the earnings a little bit positive at the start, then some negativity, and then all of a sudden now we're getting into this thing. Well, I think the more important thing is look at the PE ratio here. So for years and years and years, the PE ratio was zero. Right? It didn't help us because they weren't making any money. But yet, did that mean that Tesla wasn't a great company? That's not what it means. And this is where our PEG ratio comes in. So if we go to FinViz here, which I know most of you use FinViz, and we go into Tesla, okay, it gives us all these metrics in the chart, and that's all great, right? We can go and we can look at this PEG ratio. Okay, Tesla has a PEG ratio of 8.38. Well, what does that mean? Well, the whole point of a PEG ratio, basically, I'll give you the formula. It's PE ratio divided by growth rate, okay? All it is a company's value while including expected earnings growth. Now, I do want to caution you there. It's expected earnings growth. Now, that's not a guarantee of earnings growth, but they do put this together in the vein that, we are expecting companies to grow and make earnings in the future. That's kind of the expectation. It doesn't happen all the time, but it does happen. So this is a way to say, is a company overvalued or undervalued? That's the only rationale to go with the PEG ratio here. So if we look at this 8 number, well, what does that mean? Well, we don't really know what that means unless we compare it either to another company of similar nature, or perhaps the industry. The easy way to do this is if we click on auto manufacturers here, which is the industry that this finds itself in, we can click on this valuation metric right here, and it gives us a whole bunch of information here. The best information, or the one we're talking about this week, it gives us price to sales, price to book, price to earnings. If we just click on this PEG ratio here, okay, it's going to give us all these companies that actually have a price earnings growth ratio. Okay, so now we can look at this, and we could say, okay, so companies that are somewhat similar. Obviously, market cap matters, right? NIU and Tesla are two very different companies just because of their market cap, right? But we can see that the PEG ratio for, let's compare the one that's closest. So BLBD here is about 536 million versus 834 billion. So it's not even really close. Let's see if I can find something close. Okay, here we go. So TM, 288 billion versus 834. So still not as big as Tesla, but we can see that one has a metric of 838 and the other has a metric of 042. So if we look at that from a value ratio, and again, they're not exactly the same, but we're trying to compare apples to apples, which is what we always do. You can see here that one could be potentially, and this is I want to put that in quotes, potentially undervalued in comparison to the rest of it. So we're just trying to compare these things to other like companies or the industry itself. Okay. And again, the reason this makes sense to look at a PEG ratio versus a PE ratio, because if we go back to this chart here, our PE ratio would have shown us nothing going forward here, but a PEG ratio in comparison to other companies of a similar nature, would have showed us, does Tesla have potential to quote unquote grow up? And that happens quite often. You do have companies that, okay, they don't all come out of the gate making billions of dollars. They have their growing pains like everything else, but we want to kind of look under the hood of the company and say, okay, is there some potential here? And a PEG ratio is one of the ways to do that. So again, this is something you'll add into price to earnings ratio, price to sales, PEG ratio, debt ratios. You want to look at all of these different things. And like I said, one of the ways to do this is really easy, is you've got all of these metrics here in FinViz here very easily. You can see a lot of things. You can see earnings per share. You can see, price to book, price to sales. This gives you a very good idea. And then you can start to compare these things, right? You can say, okay, how's the PE ratio versus something else? How's the PEG ratio versus something else? So it's just an easy way to do that. So PEG ratio, like I said, it's not complicated, but it gives us a view of overvalued and undervalued in comparison to something else. And again, we add that to all the other fundamental metrics we have. We're building out a picture. Then we can make a decision on whether we think that stock is of value or maybe not so valuable to us for our investing dollars.